Welcome to the Australian Business Executive Podcast, where we speak with Australia's most influential industry professionals on the business and economic development issues taking place across the country. You can stay up to date with all our content, including our magazines, podcasts and videos by visiting www.theabe.com.au and clicking on subscribe.
Today's guest is Mathew Edwards, CEO and MD of ASX-listed Think Childcare. Mathew took Think Childcare to the public market in 2014 after operating a group of childcare centres since the early 2000s and the acquisition of 12 centres in 2009. Mathew had previous experience in operating a multi-site retail group, which he started from the boot of his car through to a publicly listed company. Mathew, thanks for joining us today.
Good afternoon.
So, could you give us a little bit of background on Think Childcare?
Well, Think Childcare, as you've stated, listed in 2014. We had 12 trading centres at that point in time, which had been made up predominantly from the failed ABC centres. We acquired them out of receivership. Prior to our listing, we contracted a further 18 centres that we subsequently settled post-listing, and we came to market with a plan to take what were predominantly underperforming and poor trading centres and to trade them up to a strong trading group, which we, in the main, we successfully achieved that.
Okay. For people that put their children into care and people that are looking at this as an investment, could you give us some of the facts and figures around the Australian childcare sector and your organisation?
The sector is made up from around 7,000 long day care providers. And the reason they're called long day care is they typically trade from 6, 7 in the morning to between 5 and 6 of an evening, 5 days a week. We provide care for children from 6 weeks of age through to 6 years. Think alone, we deliver about 1 million days of learning and care, and we serve over 3 million meals per year. We employ around 1,500 educators, and amongst that, we actually employ around 100 university qualified teachers. So it's certainly a place of education as opposed to a place of care. The sector is very heavily government funded, and the reason it's government funded is predominantly childcare commenced as a productivity measure to encourage predominantly mothers to return back to the workforce to become taxpayers. So we've seen as a sector that government funding has increased over the years in order to create that workforce participation and give us a greater tax base. Currently, the funding allows families to get up to 85% of $120 a day as a subsidy. So it really encourages lower income families to participate in the workforce, which then underpins our tax system.
I was just going to say, with the subsidies, it looks like this is going to continue to grow and underpin the opportunity. So, what is some of the other key information that you'd like to share for investors today?
Well, I guess the Think Childcare has grown up in full view of the public as a public company, and we always sort of operate on the premise that every decision we make is in the long-term interest of building a stable and predictable business. Last year, we actually took an aggressive position to transform the type of our offering in terms of our childcare offering. In 2017, we acquired a premium childcare brand called Nido Early School. And what we've subsequently been doing is taking a high-quality care and education offering to the suburbs rather than targeting wealthy areas. We've been taking a premium offering out into the suburbs, which is we're probably the first organisation to really focus on that quality piece. We've also been investing heavily into our operating platform across all aspects of our head office and our centre support, and sort of making those decisions and making that decision to build a company for the longer term. That investment into our head office and our centre support has probably wiped around $3 million off our earnings this year. And we're really sort of like no other childcare operator that's come to market because we are investing in our platform today to give us that growth tomorrow. Obviously, we expect that to pay dividends, I guess literally pay dividends for many years to come.
So, Mathew, you had said something quite interesting there in terms of your strategy of looking at opportunities for Think Childcare in suburbs over, I assume it would be more affluent and high-density areas. What's the theory behind this?
I guess the basis for that is that most families in the outer suburbs are aspirational. They want a better life for their children. So providing them with a high-quality offering, being best in market, ensures that you have a higher occupancy, therefore higher profitability. The other piece that occurs out in the suburbs, typically their greater subsidies are paid to families in those outer suburbs. Therefore, that underpins our revenue, given that it's paid every Tuesday to us directly from the government.
Okay. And who are the people behind Think Childcare from an investor's perspective?
Think Childcare has a very strong management team. We have Jenny Saliba, who is our CFO, and she comes to us from quite a diverse background, having worked in the property sector, running sort of multi-billion-dollar funds, having worked in aged care, engineering, done a lot of restructuring. So she is certainly the powerhouse behind our transformation from our financial management and our service delivery at a centre. Over and above that, we have several general managers who drive the operations, and we have sort of around 1,500 employees across the organisation, with predominantly the real force, I guess, sits in our educators at a service level.
Okay. You had mentioned her background in real estate. Outside of, the growth of the company on the need for childcare and subsidies through the government, does the strategy of real estate play any part in Think Childcare, or all the properties leased?
We're a leasehold operator. We work very closely with various developers around the country, from the big end of town to the mum and dad developer who does 2 or 3 centres a year. At this point in time, we don't see participating in that freehold investment is a strategy for Think, but certainly it's something that we have on watch as and when opportunities present themselves. We may take advantage of those market conditions, but at this point in time, it's not part of our strategy.
Okay, and childcare as a sector and as an industry, is it fairly homogenous, or is there a philosophy that makes Think Childcare different to other players who exist in the market?
I think most operators that sit in the market will operate a typical run-of-the-mill childcare service. And certainly when we first came to market, that's exactly what we had, and we described it probably as your Kmart type offering. It was honest, good childcare service, but there was no differentiator in terms of our service delivery. And when you do that, you just get your share of the market. So everybody sits at 70% occupancy, you're at 70% occupancy. In 2017, we acquired the premium brand Nido, and that's sort of, as I discussed before, we've moved our business to transitioning all our services to a Nido quality service, which is a exceeding quality of care and education. It's actually slightly more expensive to deliver that care, but ensures higher occupancy and therefore higher profitability. And we're sort of in the process of transitioning all our services to the Nido model. And by the middle of next year, we'll be fully transitioned, we expect.
Okay. And, do you have any intel or research on what parents themselves are looking for and the things that are driving their decisions in childcare?
Certainly. Childcare, by the word being care there, is a critical piece, but it's a place of education. We have a curriculum we follow. We have a school readiness program. We have to program in terms of educational outcomes per child. We employ university-educated teachers who can work in a school environment up to 12 years of age. So whilst we call childcare, and some people still see us as a creche, certainly families now understand it's a place of education. So for us, the biggest thing that we see families wanting is to help build a resilient child. They're going to have lots of challenges in their life as they go through life, and there's going to be lots of knocks, and it's getting them ready for that, and also building a love of learning now. Yes, look, what happens in the first 5 years of your life is absolutely critical for brain development. And just to give you an example, the brain makes new connections. In an adult, you make about 1,000 new connections a second. In a child, you make around 3 million new brain connections a second. So what happens in the first 5 years of life is absolutely critical, that brain development. So what families are looking for is to ensure that we help prepare a child for the rest of their life, that we allow them to be little, we build sort of that resilience into a child's makeup, and we provide an environment that's full of love and caring that ensures that a child has a sort of love of learning, which then carries them through the rest of their life. So it really is a very critical time, which is why we invest heavily in terms of our education quality, in terms of our curriculum, and why we also employ sort of university-educated teachers to ensure that we're giving the children the very best they can and preparing them for the next step in their life.
Okay. And where does Think Childcare see its growth in the medium term?
Our growth comes from several areas. One is through acquisition. We have a very unique model where we develop childcare services with incubator partners. We manage those childcare services until they trade up to what we call our bankable metrics, which is around 75% occupancy and at a certain profit level. And we then acquire those centres off our incubator partners at 4 times earnings, with typically an earn-out and a clawback arrangement. It means we have minimal integration risk, and as far as everybody is concerned from day one, it's a Think Childcare service under our Nido brand. We also will sort of start to enjoy some economies of scale as we sort of complete the investment in our transition to Nido, and also we complete the transformation of our operating functions and our operating platform. And that'll see us sort of be able to operate at scale in the future. And ultimately, that's something we probably, with hindsight, should have done pre-listing, but it's something we've, as I said before, we've sort of actively invested in now. The other piece is through our organic growth in terms of our capital investment. We're transforming our existing services to the high-quality Nido, and we're investing sort of up to $7 million into our existing centres to take them all up to best in market. Interestingly, we're the first listed childcare operator to actually invest a large amount of capital back into our existing businesses. Most other operators have come to market, just continue to acquire. So we sort of said, stop, we need to fix up what we've got to make sure every one of our services is best in market.
Okay. Look, that's a lot of information, but before we finish up today, is there anything else that you haven't had a chance to address or that you'd like to add?
Look, I think it's important for investors to understand that we're building something that is built to last. I guess there are many businesses out there in the listed space who typically make decisions based on their share price and sort of bend to the market to whatever they think the market perceives or what they perceive the market wants them to do. We're steadfastly driven on building a robust business and, always ensuring we've got a balance between operational risk and acceptable debt exposure. And we certainly see the best years for the sector and the best years for Think Childcare are still ahead of us.
Mathew, thank you for your time today.
Pleasure.
This has been a production of the Australian Business Executive, a division of Romulus Rising Proprietary Limited. All rights reserved. You can stay up to date with the Australian Business Executive, including our magazines, podcasts and videos, by visiting www.theabe.com.au and clicking on subscribe.